Welcome to Iron Financial. We're the place where you forge a stronger portfolio because we cut right through the market weakness. And today, we are putting Trinity Industries squarely on the anvil. They just dropped what looks like a bombshell Q4 earnings report.
You know, bombshell is an understatement. We're talking about a staggering 230% earnings per share beat. I mean, the market went absolutely bonkers for it. The stock just soared.
And that right there is exactly why we're here. Because if you look just one layer deeper, beneath that explosive, flashy headline, you find a massive contradiction that we have to talk about. Their full-year revenue is actually down.
So that's our mission today. We are going to tear this company's report down to the studs. We're going to find out if Trinity is truly built on a solid foundation of real operational strength, or is it just a house of cards, something propped up by a little bit of financial engineering? Let's find out.
Okay, let's get into it. Here's our blueprint for the investigation today. First, we're going to deconstruct those headline numbers, the ones that sent that shockwave through the market. Then, we'll get to work forging the bull case. We're going to examine the core steel frame of the business itself.
And then, my favorite part. We go searching for the weak points. We're going to look for any cracks in the armor. After that, we'll put it all through a durability test by looking at their blueprint for 2026.
And at the very end, we deliver the iron verdict. All right, let's get to work. So, these Q4 2025 numbers hit the street, and they just sent a jolt right through the system. I mean, on the surface, this thing looks like an absolute blowout quarter, a real monster of a report. Right, but it created a really confusing picture for investors, didn't it? Everyone's trying to figure out what's real and what's just noise. How on earth does a company in a pretty tough market suddenly print a number that looks like that? That's the million-dollar question. So let's just look at the raw power of these headline numbers first, before we start peeling back the layers and really applying some pressure.
Okay, just look at this number for a second. $2.31. That is the reported earnings per share, their profit, for the fourth quarter. Now, for a company that operates in a tough, cyclical market like railcars, a number this big, it absolutely demands your attention. This is the kind of figure that makes trading algorithms just go haywire and sends portfolio managers scrambling to figure out what they missed.
But hold on, here's where the story gets really wild. The Wall Street consensus, the collection of all the analysts who follow this company for a living, they were expecting just 70 cents. 70. That is not a small miss. That is a chasm. The so-called experts were looking at the exact same market, the same railcar industry, and they came up with a number that wasn't even in the same zip code. Honestly, it makes you wonder what on earth they were looking at.
So, what this all boils down to is a 230% earnings surprise. Let me just say that again, because it's almost hard to believe. 230%. This isn't just a beat. This is a complete and utter demolition of expectations.
And in our line of work, a surprise of this magnitude is a massive, massive red flag. It forces you to stop and ask the really hard question. Did this company just suddenly, overnight, become the greatest company in the world? Or is there something else going on under the hood that we need to find? Exactly. You just don't see surprises like this without a very specific and often a very unusual reason behind them. And of course, you know how this goes. The market reacted instantly. An 8% jump in pre-market trading. It's a powerful, decisive move. But this right here, this is exactly where we have to step in and apply that pressure. Is this explosive move truly justified by a fundamental, positive change in the business, or is it just a knee-jerk reaction to a flashy and maybe even a misleading headline?
Well, the market often shoots first and asks questions later. Our job here is to ask those questions right now.
That is absolutely the right question to be asking. And to answer it, you have to look past all that headline noise, and you have to examine the structural steel of this company. See, the bull case for Trinity isn't built on a single surprising quarter. No, it's forged from this massive cash-generating engine that sits right at its core, the leasing business. This is where the real strength lies. So let's fire up the forge and see how solid that frame really is. And this slide right here, this just perfectly illustrates the point. Forget about the lumpy manufacturing cycles for just a moment and look at these numbers. The leasing business is an absolute fortress. Full-year leasing revenue is up a really solid 5.5%. Fleet utilization is at a rock-solid 97.1%. That means their assets are out there working, making money, not just sitting idle in a yard somewhere. They're successfully renewing 73% of their expiring leases, and here is the real kicker. The new rates on those renewals are 27% higher than the old ones. And this isn't some one-time fluke. Their future lease rate differential has been positive for 18 straight quarters. That's 4.5 years of consistent, powerful pricing power. This is the load-bearing pillar of the company. It just generates powerful, predictable cash flow no matter what the manufacturing side of the house is doing. And what does a company with that kind of powerful, predictable cash flow do? They return it directly to the people who own the company, the shareholders. $170 million in 2025 alone through both dividends and share buybacks. Now, this isn't just a number on a chart. It's a signal. It's management demonstrating extreme confidence in their business model's ability to consistently generate cash through thick and thin. And they just recently boosted the quarterly dividend to 31 cents a share. That's now 7 consecutive years of dividend growth. You don't commit to that. You don't keep raising that dividend year after year after year unless your foundation is absolutely rock solid. And look, the CEO, Jean Savage, she said it herself on the earnings call. Structurally stronger, more resilient, and better positioned. Now, these aren't just empty corporate buzzwords she's throwing around. This is the mission statement. The bull case argues that management has spent the last few years intentionally fortifying this entire business, retrofitting it to withstand the cyclical downturns that are just inevitable in the rail industry. They believe they have built a structure that won't just survive the coming storm, but can actually thrive right through it. And this right here, this is the hidden strength. This is the rebar reinforcing the entire structure. On their balance sheet, their accounting documents, they carry their massive fleet of over 101,000 railcars at a cost of $6.3 billion. But here's the thing. The company estimates the actual market value of those same assets is 35 to 45% higher.
And that is a massive reserve of untapped value. It's a hidden cushion on the balance sheet that the market might not be fully appreciating. We're talking about billions of dollars in unrecognized, real-world value here.
It really speaks to decades of smart asset management and appreciation, and it gives them immense flexibility. They can just hold these cars and collect higher and higher lease payments, or they can turn around and sell them into the secondary market at a significant profit. This is a powerful strategic advantage that they have. All right. I'll admit, that's a pretty compelling bull case. That leasing business looks like an absolute fortress, and that hidden asset value is definitely impressive. But here at Iron Financial, we don't just admire the architecture, we bring out the sledgehammer. Every single structure, no matter how strong it looks on paper, needs a real stress test. So it's time to start hammering on the weak points and see what, if anything, starts to crack. It's time to ask the really hard questions. And here it is. This is the central, the unavoidable question. It's the one that flashy headline EPS beat tries to distract you from. If the core leasing business is such a powerhouse and the company is structurally stronger than ever before, why did their total top-line revenue for the entire year actually shrink? I mean, this is the fundamental contradiction we have to resolve. Profits cannot grow forever if your revenue is going in the wrong direction. Something just doesn't add up here. You're right, let's just visualize this because it's a truly bizarre picture when you put them side by side. On one hand, you have full-year earnings per share that just skyrocketed by 73% to $3.14. That's an incredible performance by any measure.
But then on the other hand, full-year revenue of $2.2 billion represents a decline from the year before. So how is this even possible? How can profits be soaring to the moon while the amount of money coming in the front door is actually shrinking? This is not organic growth. This points to something else, something much less sustainable. So the real question we have to answer is, where did that profit really come from?
Okay, to understand the answer to that, we have to talk about something called a non-cash gain. Now, this is a critical concept for any serious investor to understand. It's basically a profit that shows up on the income statement, which makes that EPS number look absolutely fantastic, but it doesn't represent actual cash coming into the company from its day-to-day core operations. It's often the result of a one-time accounting transaction.
You can think of it as a form of financial engineering. It's perfectly legal, of course, but it can be a misleading way to boost your numbers. It creates a flashy headline that gets the market all excited about the wrong things.
And here it is, $194 million. This, right here, is the source of that shockwave. The massive Q4 earnings beat wasn't driven by selling a record number of new railcars or by signing a bunch of incredible new lease deals. Nope. It came from a one-time accounting maneuver related to a railcar partnership restructuring with a firm called Napier Park. This single transaction accounted for about $1.50 of that $2.31 EPS in the fourth quarter. It's the ghost in the machine. Okay, I'll walk through the mechanics of this deal because it's actually important to understand. Essentially, Trinity and Napier Park did a kind of asset swap to simplify a joint partnership they had. Trinity took full ownership of one fleet of about 6,200 cars, and in exchange, Napier Park took full ownership of another, larger fleet of almost 11,000 cars. The critical part is step 4. The fleet that Trinity gave up, that Triumph fleet, was valued in the transaction at a price significantly higher than what Trinity was carrying it for on their books, and that difference between the sale price and the book value created the $194 million non-cash gain. Now, from a strategic standpoint, it's a smart move. It simplifies their ownership structure and it unlocks some of that hidden asset value we were just talking about.
But, and this is a huge but, it is not a repeatable operational victory. This was a one-time event. You can't do this every quarter. And it effectively papers over the fact that their core manufacturing revenue is down because they're in a weak market. You can't just pull this rabbit out of the hat every time you have a bad quarter.
You know what? That's a completely fair point. The one-time gain is a critical piece of the puzzle here, and the market weakness is absolutely real. But the true test of any structure, any company, isn't just how it looks today. It's how it's designed to handle future stress. So let's put the past quarter aside for a second and look at the company's own blueprint for 2026. This is where we see if that foundation is truly built to last, or if it was just designed to look good for one single quarter. And I gotta tell you, that blueprint is flashing some major warning signs. Just look at this guidance. After reporting a full-year EPS of $3.14 in 2025, they are guiding for just $1.85 to $2.10 in 2026. That is a massive drop. That's a potential haircut of over 40% from the high end. They're also forecasting total industry railcar deliveries to fall from around 31,000 all the way down to 25,000. This is management telling us, in plain and simple numbers, that the cyclical downturn is real and it's here to stay for a while. The 2025 results were artificially inflated by that one-time gain, and 2026 is what reality actually looks like. This week guidance, to me, is the biggest crack in the armor. And you don't even have to take my word for it. Just listen to the CEO again. She is explicitly signaling a tough year ahead. She says they're seeing inquiries pick up, which is good, but then she pushes out any real hope of a recovery to 2027 at the earliest. And her words are, expect 2026 to be a little bit lower. That's the CEO managing expectations. She's telling the market to brace itself for a difficult, low-volume year. This confirms that the headwinds they're facing are strong and they're persistent. But this is exactly where the bull case fires back. Yes, the volume is down, the market is weak, nobody is denying that. But this slide right here shows how they prepared for it. This isn't just about surviving, it's about building a more durable, more resilient business. They've implemented serious cost discipline, including right-sizing their headcount last year. They've invested heavily in automation and technology to permanently lower their break-even point in manufacturing. And this AI integration, it's not some pilot program or a buzzword for an investor presentation. It's embedded in their daily operations with serious partners like Palantir and Databricks. They are using it right now to reduce scrap material, improve logistics, and accelerate their collections. The crucial point is this. Look back at their rail products margin guidance. Even with industry deliveries falling off a cliff, they still expect to maintain a 5 to 6% margin. That right there is the definition of resilience. They have structurally changed the business to protect profitability even in the eye of the storm. So, we've laid it all out. We have examined that headline shockwave, we've forged the bull case from the solid steel of the leasing business, and we hammered on the weak points of declining revenue and those one-time gains.
And we've stress-tested their blueprint for 2026. All the evidence is on the table. So it's time to weigh the structural integrity against the market pressures and deliver the final iron verdict.
Our verdict is this. Trinity Industries represents a structurally sound opportunity that is currently being masked by cyclical headwinds. Now, the bear case is valid, the weak guidance for 2026 is real, and the reliance on that massive one-time gain to juice the 2025 numbers is a legitimate concern. But we think that view is too focused on the temporary storm. The bull case is more powerful for a long-term investor. The foundation of this company, that immensely profitable and stable leasing business, the hidden asset value on the balance sheet, and the permanent structural cost improvements they've made to manufacturing is incredibly strong. They have proven they can protect their profitability and return huge amounts of capital to shareholders, even when the market is against them.
The risk of a weak 2026 is clear, and the market is right to be cautious. But the underlying structure here appears solid enough to weather it and emerge stronger on the other side.
And that leaves us with the final question, the one that you have to answer for your own portfolio. The market is clearly focused on the cyclical slowdown and that weak forecast for the next year. But beneath all that surface noise, Trinity's own blueprint shows a company that has been fundamentally rebuilt for resilience. So the choice for an investor is pretty clear. Do you wait on the sidelines for the storm to pass and potentially miss the turn? Or do you recognize the underlying strength here and start building your position now while the market is distracted by the short-term clouds? That is the decision you have to forge. Thanks for joining us here on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.